This is a complete crypto tutorial from an expert. This tutorial is going to teach you how to trade crypto from the scratch, whether you don't know about crypto or you know a little about crypto. In this tutorial, we are going to learn how to get started with crypto, what is crypto, what is trading, what is day trading, swing trading and scalp trading. We are going to learn about investing in crypto and how you can do a proper fundamental analysis of the cryptocurrency market. Also, you will learn how to do technical analysis so that you know when to buy or when to sell a crypto asset, when to take a long trade and when to take a short trade, how to enter the market and how to exit, and how to do everything crypto related, all embedded in this video. Also, I'll talk about what platforms do you use and how to place trade on all these platforms. I'll also put a link to some other important information in the description box below, and this video has timestamps so that if you already have knowledge about some part of the content, you can actually skip to some others so that you get straight to whatever you want to learn if you have learned some other aspect of what you have in this video and get straight to the point. The video is about 2 hours and I understand it is long, but it is worth it. So if you get value from it, ensure you hit that like button and also subscribe to the channel. So let's get in right now. So going into this course, we will start with what is cryptocurrency. You know, if you want to learn how to trade the cryptocurrency market, you actually have to understand the concept of cryptocurrency as the first thing, as the introductory part. So let's talk about cryptocurrency. Cryptocurrency is a digital or virtual currency that requires cryptography for security and is decentralized, meaning it is not controlled by any government or financial institution. So now when we talk about the meaning of cryptocurrency, it's simply an asset. A cryptocurrency asset is an asset that uses cryptography as a means of confirming transaction and as a means of security, and it's decentralized, which means you cannot have access to it, but you can see what is happening in the network. So talking about cryptocurrency, nobody in the world can directly have access to a transaction that is performed in the cryptocurrency market. You can't block a transaction, you can't directly have an impact on the transaction, but the blockchain, which is like a place where cryptocurrency is hosted, is a public ledger where you can see all the transaction that is happening without having a direct access to it. So if you look at conventional banks or conventional money, which is the fiat currency, you see that if you have a bank, your government can instruct your bank to block your account. They can obstruct a transaction. You can carry out a transaction and it will be reversed. But in cryptocurrency, nothing like this can happen. So crypto is a decentralized virtual currency. And when we say virtual, it means it is not physical. It can only be used over the internet or on your wallets and using a software. So it is not physical, it is a virtual currency. So now what are the key characteristics of a cryptocurrency? The first thing is that it is decentralized, which means it operates independently of central banks and governments. So no central bank, no government has access or control over it. The second one is it is digital, which means it only exists in electronic form. So cryptocurrency is digital and it is not physical. Alright, the third one is limited supply. Most cryptocurrencies have a capped supply, which means their supply cannot exceed a particular amount. So let's look at Bitcoin, for example. Bitcoin has a limited supply of 21 million Bitcoins. I didn't say $21 million, I said 21 million Bitcoin, which means in the world, you can't have more than 21 million Bitcoins. And out of these 21 million Bitcoins, more than 19 million is already in circulation. This makes cryptocurrency scarce, so that once all the 21 million Bitcoins have been mined and is already in circulation, all people all across the world have to compete for this 21 million, which is going to make it a scarce commodity and a price commodity. And that is one of the economical fact that's going to give you this fact that's going to tell you the fact that crypto is going to always rise in value, especially Bitcoin and some other cryptocurrencies that have that kind of value. So the next one is it is fast and global. You can send, if you use Western Union and all those money transfer, it can take you some hours or even days before the person that's sending the money to gets the fund. But with crypto, you can send USDT and have it delivered. You can send $1 million, $5, $10, $50 million and more worth of USDT and have it within 3 minutes. It is fast and it is global. You can send it to any place in the world. Also secure. Crypto uses cryptography to protect transaction and control creation. And also it is anonymous. Can remain anonymous. Users can remain anonymous, but transactions are public. So let's look at this. When you send a cryptocurrency in the cryptocurrency market, you that is sending the cryptocurrency, you are anonymous. Nobody knows you, but the transactions are public. And it is public because of transparency, so that everything that is happening in the cryptocurrency ledger, on the blockchain ledger, will be seen by everybody. So let's say, for example, someone transfers $50 billion worth of Bitcoin from one wallet to another. You can see it on the blockchain network, and I'll tell you more about how to see it later in this video, right? But who sent it, you will never know. That is why it is anonymous using the cryptocurrency market. So now, how does cryptocurrency work? Cryptocurrency works through blockchain, which is like a public ledger that records all transactions. So blockchain is more like the ledger where all transaction is recorded. All transaction that's happening in the cryptocurrency market is recorded. Also, cryptocurrency is formed through mining. Computers solve complex math problems to validate transactions and create new coins. So now, for new coins in the cryptocurrency market to be created, there must be something called mining. So when computers, whose complex computers that solve complex mathematical problems, are those computers that mine coin. So once they solve this problem, they mine coin, and once the coin goes into circulation, they get a reward for mining every coin they do. So now that is how cryptocurrencies come into place. Also, there are wallets, which are software programs that store, send, and receive cryptocurrency. I'll talk about wallets also later in this video. So now, uses of cryptocurrency. What are cryptocurrencies used for? The first thing is cryptocurrencies are used for payments, online transactions. So cross-border payment, maybe you want to pay there. Now you can go anywhere in the world and see places, maybe stores, grocery stores, lounges that accept crypto payments. You now see universities that accept crypto payments in some part of the world, like Canada and all those countries. You see different businesses accepting cryptocurrency in El Salvador and other parts of the world. You see cryptocurrency ATMs all across the world. So that is it. So it is used for payment, online transactions, cross-border payments, and also it is used for investment, trading, or holding for value acquisition. So you can trade the cryptocurrency market just like you trade stocks and forex. Also, you can hold it just like you hold gold, real estate, and other assets, that's tangible assets that you hold and make money from the appreciation. Smart contracts, automated self-executing contracts like Ethereum are also part of the use of cryptocurrency, and also remittances, low-cost standard money transfer. So imagine you want to send like $5 billion from your bank. You know the stress you have to go through before you can be able to wire this money from your bank, and you know what charges that wire would incur. But with cryptocurrency, you can do it with just maybe $2-3 charges, and you are good, right? So now, benefit of cryptocurrency: financial inclusion. It gives you access to financial services for the unbanked. For people that don't use bank, you can actually use crypto. Also, security. Cryptographic protection against fraud and tampering. Crypto actually gives you a kind of security where you can receive money without having the fear of your transaction being influenced or being cornered when being sent. And also, it is fast. It has speed, a very fast speed. You can send USDT, and literally within 2-3 minutes, millions and billions of dollars are already being sent. And autonomy, it is decentralized and user control. You control your currency. Once you have your keys, your private keys, you are in control of your money. Nobody is going to freeze your money and stuff like that. So now, what are the risks associated with cryptocurrency? The first one is volatility. Cryptos are highly volatile. Bitcoin price can be $62,000 today, and it can be $55,000 tomorrow, and even way lesser. And it can also be $52,000 today and $100,000 tomorrow or next week. So the prices fluctuate. Bitcoin goes up and down, Ethereum goes up and down. Other cryptocurrencies like Solana, Cardano, Mana, Shiba Inu, Dogecoin, DC, all the cryptocurrencies are volatile, which means their prices go up and down. So you have to be able to do a proper analysis to be able to navigate the cryptocurrency market. Also, security risk. sometimes there are hackings and thefts. Sometimes if you misplace your private keys, your wallet can be hacked. Also, regulatory uncertainty. Looking at the fact that cryptocurrency is a new market that was just created in 2008, there are some regulatory uncertainties that are now with crypto. Some countries are not accepting it, some countries are accepting it. And this is one of the challenges that come with crypto. Also, market manipulation, because cryptocurrency market is still young. You can't compare cryptocurrency market that is just about $4 trillion market cap with the forex market that trades almost $7 trillion every day, every single day, right? So, whales, people who have large quantity of money in the market can actually manipulate the market, right? Now, let's talk about the brief history of cryptocurrency. The concept of cryptocurrency began in 1983 with David Trump's e-cash, an early digital currency. Also, sometime in 1995, the first cryptocurrency, Hashcash, was developed by Adam Back. But the real cryptocurrency that we have today was not developed until 2009, when Bitcoin was launched by Satoshi Nakamoto. Satoshi Nakamoto is a person or a group of people who adopt this name. This is not actually their real name. They just adopted the name as like a proxy name. And they created, Bitcoin was launched in 2009 by Satoshi. Now, Bitcoin decentralized peer-to-peer network and blockchain technology paved the way for thousands and millions of alternative cryptocurrencies or altcoins, such as Ethereum. Ethereum was launched in 2015, Litecoin in 2011, and every day new cryptocurrencies are being launched. Right? So in cryptocurrency we have two major kinds of currency. We have coins and tokens. So let's talk about coins and tokens. In cryptocurrency, coins and tokens are often used interchangeably, but they have distinct differences. So let's talk about coins, because in the crypto market you hear, I've bought that coin, I've bought that token. What do these things mean? So coins means a native cryptocurrency that has its own blockchain. Most times, tokens do not have their own blockchain. They rely on the blockchain of a particular coin. For example, Ethereum is a coin, right? Bitcoin is a coin. It has its own blockchain. Ethereum is a coin. It has its own blockchain. But Ethereum blockchain hosts a lot of other coins on a lot of other tokens on its blockchain, right? So that's it. So coins have their native cryptocurrency, which is like they have their own blockchain. They have an independent network, like they operate separately from other cryptocurrencies. They are mined, like Bitcoin. Like I said earlier, Bitcoin is, and most of other coins, they are mined. They can be mined through proof of work or proof of stake, and they have examples like Bitcoin, Ethereum, Litecoin, Monero, and a lot of other cryptocurrencies that are coins. Now let's talk about tokens. Tokens are built on existing blockchain. They build them on blockchain of other crypto asset that has been in existence, right? So, like the Ethereum blockchain, they are dependent in network, which means they rely on the host blockchain. They rely on their security and functionality. They are not mined, which means tokens are created through smart contract and other mechanisms. And also, example of ERC20 tokens. All these tokens mentioned, like DAI, Link, Uni, they are ERC20 tokens, and they are not actually coins, they are tokens, which rely on the Ethereum network. Ethereum network is ERC20 token, right now. And also TRC20 token, which like it's USDT, which is Tron. It also relies on that TRC20 token. Now, what are the key differences between coins and tokens? The first one is blockchain ownership. Coins have their blockchain, while tokens share someone else's blockchain. Mining. Coins are mined where tokens are not mined. They are just created through other means. And independence. Coins are independent, whereas tokens rely on the host. They rely on their security and function and other things for functionality. Alright, so blockchain token type. We have different kinds of tokens in the blockchain industry, in the crypto industry. We have utility tokens, which provide access to services or products, such as Filecoin. We have security tokens that are created for security of maybe some companies or some assets, like some dividend paying tokens. We have NFTs, which are non-fungible tokens, which are like some unique tokens that cannot be recreated, like arts, like collectibles. You know, in 2019, 2021, it was the NFT season. Now we have a lot of celebrities patronizing the NFT world, and also we have governance token, like grant voting rights in decentralized. Now let's talk about Bitcoin. Let's talk about Bitcoin and some other cryptocurrencies. So the first cryptocurrency that was created was Bitcoin, right? The first cryptocurrency that was created was Bitcoin. It's the first and the most well-known cryptocurrency all across the world. It was created in 2009 by Satoshi Nakamoto, and it has the largest market capitalization of over $1 trillion. It is considered, Bitcoin is considered a store of value like gold, like digital gold, and it has a limited supply of 21 million Bitcoin, like I said earlier on. Then after Bitcoin, we have something we call altcoins, or we can call it alternative to Bitcoin. Any other cryptocurrency apart from Bitcoin is called an altcoin. You have to understand that concept. Altcoin means alternatives to Bitcoin. So it means that when Bitcoin recorded its success, people started creating some other coins, and we call them altcoin, which are alternatives to Bitcoin. So cryptocurrencies other than Bitcoin are altcoins. They are launched after the success of Bitcoin. Example are Ethereum, Litecoin, Monero, Cardano, Shiba, Dogecoin, DC. All these coins, XRP, all of them, they are called altcoins. They are often created to improve upon Bitcoin features or offer new functionality, and can have different consensus, algorithms, security measures, and use cases. So more like, it's safe to say that Bitcoin it paved the way for all these cryptocurrencies. Also, we have something we call shitcoins, right? As the name implies, it is a colloquial, which is like a derogatory term for low quality or scam cryptocurrency. So when you hear shitcoin in the cryptocurrency market, it means a coin that is usually created for scam. And you will not know except you understand the concept of fundamental analysis, which we will later be talked about in this video, right? So it's also coins with little or no value or no use case. They are projects with poorly managed design, technology, or economics, and they are coins created solely for speculative purposes or pump and dump schemes. So these coins are usually coins that some people create just to scam other people, and the scam gun people who do not have enough knowledge of the cryptocurrency market. That's why it's important for you to make sure you watch this video to the end, so that you get all the value you need to know, so that you don't fall into traps of shitcoins. Now, shitcoins are often characterized by low liquidity, poor community support, lack of transparency, and unrealistic promises. Now, let's talk about what we call stablecoins, right? Stablecoins are cryptocurrencies designed to maintain a stable value relative to traditional currency. We all know that in cryptocurrency market, cryptos are volatile. They are highly volatile, which means their price go up and down. Now, with the fact that cryptocurrencies are volatile, some coins were now created, some cryptos were created to be able to represent the fiat currency in the cryptocurrency world. And that is what we call stablecoins. So stablecoins are coins that are stable. They don't go up and down in price. USDT, for example, is a stablecoin. USDT maintains the same price every day, every time, right? There are some other stablecoins too. So let's go through what we have here. So they aim to reduce price volatility, making them suitable for payment, remittances, DeFi application, and hedging against market fluctuation. So for example, you have Bitcoin and the price is going down, and you're like, oh, I don't want my asset to decrease in price. You can convert them to a stablecoin, which will be stable and which will not have fluctuation in price. So stablecoins are either backed by fiat currencies like USD in the case of USDT. So for example, USDT is a stablecoin. It is backed by a fiat currency. You know what fiat currency is? Currency that is not cryptocurrency like US dollar, Nigerian naira, Ghanaian cedis, Australian dollar, Japanese yen. All these are fiat currencies. So there are some stablecoins that are backed by fiat currencies like USDT, like US dollar in the case of USDT and USDC. So USDT and USDC are stablecoins backed by the United States dollars. Also, some stablecoins are backed by commodities like gold in the case of PAXG, which is a stablecoin backed by gold. And other cryptocurrencies, some stablecoins are backed by other cryptocurrencies. This T logo we have here is a sign of stablecoin, which is for Theta, which is USDT. Now, popular stablecoins, USDT, which is Theta, USDT, which is USD coin, DAI, which is DAI stablecoin, PAX, USDP. All these ones are stablecoins that will not increase or decrease in value in the cryptocurrency market. Also, use cases of stablecoin. Use them for payments. Use them for decentralized lending. There is something called crypto lending, which we'll also talk a little bit about later on in this video. So you can use USDT to lend and borrow money in the cryptocurrency market. Stable yielding farming. You can also use them to farm other cryptocurrencies and earn money. You can also use them to hedge against market volatility, because when the market is volatile and the price of your asset is going down, you can actually get these stable coins and use them to hedge against the volatility of the market. And they use them for e-commerce payment on different websites, different e-commerce platforms to make payments. Also, now let's talk about the risk associated with crypto. Cryptocurrency carries significant market risk, including volatility, liquidity risk, and market manipulation. These are the three major risks associated with the cryptocurrency market. Volatility, which means the market can go up and down, right? Liquidity risk, which means some big people in the market can pull out money from some project, which is going to affect the liquidity of the market. Liquidity simply means money available in the particular market. And market manipulation, right? Prices can fluctuate rapidly, making it challenging to predict returns. Also, there are security risks in the cryptocurrency market. So hacking, theft have also occurred in the cryptocurrency market. That's why it's important for you to learn the in-total of cryptocurrency market so that you know how to protect your wallet, how to protect yourself in the cryptocurrency market. So to mitigate this risk, investors should educate themselves, diversify their portfolio, and stay informed about market developments. It is essential to use reputable exchanges and wallets, enable security measures, and consult with financial advisors. Alright, so people will be like, okay, since theft and hacking occurs in cryptocurrency, I don't want to trade crypto. Okay, what of traditional banks? Hacking happens, theft happens in traditional banks as well. So it happens everywhere. So you as a trader, you as a cryptocurrency enthusiast, you have to learn how to protect yourself from this kind of scenario. Now, let's talk about crypto trading and crypto investing. So how do you make money from crypto? There are two major ways. There are actually a lot of ways by which you can make money from the cryptocurrency market, but we are going to talk about two major ways that is popular. The first is crypto trading and the second is crypto investing. So what is crypto trading? Crypto trading focuses on short term. So it means you are trying to buy an asset or sell an asset within minutes, hours, or a few days, and within these minutes, hours of days, you will have made a profit. Your goal from trading is to profit from price fluctuations. So as the price is going up or down, you make money from it. For example, let's say Bitcoin is at $62,000 per Bitcoin and it goes up to $62,500. Then you buy it at $62,000 and sell at $62,500. That is simply an art of trading, right? You are literally making money from short-term price fluctuation. So now, when you talk about trading, there are three major basic strategies used in trading. The first is day trading, the second is swing trading, and the third is scalp trading. Also, use something we call technical analysis. This is something that teaches you, that tells you how you'll be able to predict where the market is moving. Is the market moving up or down? Is Bitcoin going to rise in price or dump in price? So that's technical analysis. So what are the risks that are associated with trading? High volatility. Market is highly volatile. So, for example, if you are predicting that the market is going to go up and it doesn't, you may lose money. Market manipulation, liquidity risk, and overtrade. Some people overtrade and maybe they have traded and they have made money. They'll be like, oh, I can make more, I can do more, and they end up losing their money. Right? So those are the risks associated with trading. Reward, quick profit. You can make quick profit if you are so good on trading. And the aim of this video, this course, is to teach you how to be a very good trader, right? Exciting and dynamic market. Crypto is very dynamic and exciting. There are a lot of money to be made from the market. Let's talk about crypto investing. Crypto investing is a long-term focus, which means you are planning to hold a particular asset for a very long time. You are holding for months or years. Some people have been holding Bitcoin for the past 10 years, some people for the past 7, some people for the past 6 months, some people for the past 1, 2, 3 years. So that is investing. You are buying a coin and you are holding it for a long-term purpose. Your goal is to benefit from the fundamental growth, which means you are trying to benefit from the growth of that particular asset. So now, strategies used in investing: buy and hold, dollar cost averaging. We'll talk about dollar cost averaging later in this video. So make sure you keep watching, and make sure if you are getting value from this video, ensure you subscribe to the channel also, and give this video a thumb up so that YouTube promote it to other people. Now, dollar cost averaging, fundamental analysis. We'll talk about fundamental analysis also later in the video. Fundamental analysis is basically how can you analyze cryptos to know which one is worth your money, to know which one is going to go up in price, to know which one is not a reasonable investment, right? And also researching projects. So also risk with investing, market downtown. Sometimes markets, we have the bull market and we have the bear market, right? We'll talk about that one later too. Sometimes regulatory changes happen in the crypto market, and sometimes some projects fail, right? And lack of liquidity also. So what are the rewards that come with investing in crypto? Potential for significant growth. If you hold crypto for a long time, there is a high probability that your assets will grow in price and you make money. And also reduce risk through diversification. So let's say, for example, you invest in stocks or real estate or gold or bonds or mutual funds and all those things. You can also diversify your wallet by investing in crypto. And also, crypto supports innovative projects. Different new projects are now in the cryptocurrency market. You see the NFTs, you see AI, you see reward asset, and all those things happening in the cryptocurrency market. All right. Now let's talk a little bit more about trading. So what is cryptocurrency trading? Cryptocurrency trading is suitable for experienced traders, those with market knowledge and risk tolerant individuals. So if you want to go into trading, you need what? You need market knowledge. You have to be able to learn how to trade the market. Then risk tolerance. You have to understand the fact that trading is risky. It comes with some risk. So you need some tolerance for this risk, and you need to be able to learn how to tolerate the market itself. And also, why investing is ideal for long term is if you are focused on long term, maybe you have some money that you don't need for the next 1-2 years, you can actually analyze crypto, look for some cryptos that you can buy and hold for those particular period and make money from. So that's it. So now let's talk about some important things in trading, which is base and quote currency. In cryptocurrency trading, there are two main currencies involved: the base currency or the BC, which is the currency being traded or exchanged. Typically, is the currency being bought or sold. For example, if you want to trade something in a normal world, let's say you want to buy this particular phone, you need money to buy the phone, right? So if you want to buy crypto too, you need a particular crypto to buy another crypto. That is what trading is. So you need two currencies. One is the base currency and the other one is the quote currency. So the base currency is the currency that is being exchanged. Typically, it is the cryptocurrency being bought or sold, right? The quote currency used to quote the price of the base currency. So now let's talk more about the concept of base and quote currency. So now, let's say you have BTC USDT, for example. The base currency is the first currency, which is BTC, and the quote currency is USDT. Now, if BTC USDT is $60,000, it means you need $60,000 worth of USDT, which is a stable coin. You know, I'll talk about USDT earlier on as a stable coin. So you need 60,000 worth of the quote currency, which is USDT, to be able to buy one BTC. I hope you get that particular point. If you get that particular point, let me know in the comment section. So the base currency is the currency that you are trying to buy. The quote currency is the one that you are using to buy the base currency. Right. So that is simply what base and quote currency. So if you also have Ethereum Euro, which means we are using euro to buy Ethereum. So euro is the Ethereum is the base currency and euro is the quote currency. LTC BTC, Litecoin, is what we call LTC. LTC, Litecoin is the base currency and BTC is the quote currency. Now, earlier when we were talking about trading strategies, we talk about three major strategies used in trading. So we talk about swing trading, day trading, and scalp trading. There are basically three ways by which you can trade in the cryptocurrency market. Three different strategies, three different ways. The first is swing trading. The second is day trading, and the third is scalping. So we are going to talk about all these concepts one after the other. So what is swing trading? Swing trading is a trading strategy that involves holding position for a shorter period of time than investing. You know, we said earlier on that if you are buying an asset and you are investing, you are looking at least 6 months and maybe a year or even more. But for swing trading, you are actually trading, but you are trading for a long time. Maybe you buy an asset and you hold it for a few weeks or maybe 1-2 months, but the time frame must be shorter than the time of investment. So swing trading is a trading strategy that involves holding position for a shorter period than investing, but longer than day trading. It aims to capture medium price movement, typically within a few days to a few weeks. So if you are doing swing trading, it means you can be holding a particular trade. You can place a trade and you'll be holding it for a few days or a few weeks. Key characteristics. When you are doing technical analysis, you are looking at 2 to 5 days to 2 to 4 weeks. You might be looking at 2 days, 3 days, 4 days, 2 weeks, 3 weeks to 4 weeks. Right? Your goal is to capture medium-term price movement. Your strategy is using trend and reversals because market trends up sometimes, it trend down sometimes. Then you use technical analysis and fundamental analysis to analyze the market and hold positions overnight. Those are the key characteristics of swing trading. So now let's talk about the second strategy, which is day trading. Day trading is a trading strategy where positions are opened and closed within a single trading day. In day trading, all your trade will not be more than a day. So it will be whether you are making profit or you are making loss, it is within a particular day, just one day. So let's say, for example, you are a day trader. It means every morning you go into the market, right? It means every morning you go into the market, you analyze some cryptocurrency, you analyze the market, and you take trades with the hope that all your profit or loss will be within that particular day, right? So that is what day trading simply means. So now, day trading requires you that you are making the goal is profiting from intraday price movement. So you want to make profit from the price movement within the day. Key characteristics of day trading: time frame. You are holding your trade within minutes to hours. With swing trading, we said within 2 days to weeks to like 4 weeks. But for day trading, it is within that day. Within minutes or hours, you are done with the trade and you are ready with your profit or loss. Goal. Your goal is to profit from intraday price movement, and your strategy is to identify short-term trend. For swing trading, long-term trend. For day trading, short-term trend and patterns. You use technical analysis, you use the chart. Later on in this video, we'll talk about technical analysis like you know. Alright, also, you close position before the market close. Risk management. Because crypto is highly volatile, you need risk management to be able to day trade like a professional. Right? You set tight stop losses and take profit, and you monitor the market news and events happening in the market. The third one is scalping, or we call it scalping or scalp trading. Scalp trading is a high frequency trading strategy that involves making numerous small trades throughout the trading day, aiming to capture tiny price movement. So, we said day trading is within a day. Scalp trading is also a kind of day trading, but with scalp trading, you are trying to take a lot of trades, capturing small movement. Let's say, for example, Bitcoin moved from $61,000 to $61,050. You see, that is a very short movement. Compared to someone that is capturing movement from 61,000 to 61,100, you can compare and see that there is actually a difference between the two. So scalp trading means you are trying to capture small moves in the market, but you want to take a lot of small moves so that you're able to make a lot of money. So characteristic time frame seconds to minutes, typically less than 2 hours. Within 2 hours, you have already made your profit and you are done with the market today for that day. Then your goal is to profit from tiny price movement. Your strategy is identify micro trends, small trends in the market and patterns. Use technical analysis and order flow. Technical analysis for day trading and scalp trading and also swing will be discussed at the end of this video. So make sure you watch till the end. Also, you need the risk management. You set extremely tight stop losses and you also monitor the market liquidity and volatility. Those things are very important when you are doing scalp trading. Now, let's talk about the concept of cryptocurrency wallets. You must have heard of wallets. What are cryptocurrency wallets? A crypto wallet is an application that functions as a wallet for your cryptocurrency. You know, what does a wallet do? You keep your money inside the wallet. In cryptocurrency, where do you keep your cryptocurrency? Inside the wallet. So it is called a wallet because it is used similarly to a wallet. You put cash and cards in. So instead of holding these physical items, it stores the pass keys you use to sign for your cryptocurrency transaction and provide interface that lets you access your crypto. So basically, in crypto, when you are trading crypto, you need a wallet. What does a wallet do? Your pass key. Your pass key are the keys that authorize transaction, right? And your wallet store your pass key and give you access to be able to see what kind of cryptocurrency are you holding and in what amount or in what volume are these cryptocurrencies. So now we have two major types of wallet. We have the hot wallet and the cold wallet. And when we say hot or cold, they are not basically about something doing 100 degrees centigrade, 100 degrees C. So it's not about that. We'll explain what hot wallets and cold wallets are very shortly. So what are hot and cold wallets? What are hot wallets? Hot wallets are software-based cryptocurrency wallets that are connected to the internet, allowing for convenient and fast transactions. So now, hot wallets allow you to connect your wallet to the internet, which means you can just pick up your phone, log in your wallet, and you'll be able to access your crypto and trade. That is what hot wallet simply does. Cold wallets are majorly hardware wallets that are not directly accessed on your phone. Right? We'll talk about that one later. So, characteristic of hot wallet, it has an online storage, which means you use it online on your phone. Software-based digital wallet, desktop, mobile, and web, which means you can use it on your laptop, on your web application, and on your phone. Convenient accessibility, which means anything that is on your phone is conveniently used. Easy access and transaction. Also, higher risk, which is vulnerable to hacking and malware. That is the disadvantage of hot wallets, and real-time transactions, which are faster. So what are cold wallets? Cold wallets are offline storage solution for cryptocurrency. So as you can store crypto in a wallet online that you can easily use on your phone, you can also store crypto in a wallet offline. So these kind of wallets are called cold wallets. So cold wallets are offline storage solution for cryptocurrencies, providing secure and protected storage for your private keys. So what are characteristics of cold wallets? Offline storage is not connected to the internet. It is hardware based, which means it is physical device like a USB. The USB will store, understand this concept, it's going to be like a USB or a ledger. The USB or the ledger will store your private keys. Then there will now be a website for that wallet. Once you log in on the website online, you now input the private key that is in your USB majorly to access your account. So it is not that difficult, but it is not directly online. It is stored, your private keys are stored in your USB or a ledger. It is a secure wallet, which means your private keys are not stored online. They are rather stored offline. And it is low risk, which is because it's protected from hacking and malware. If the USB gets corrupted or if the USB is lost, Someone cannot even see it, and the person will not know what kind of wallet you are using. They will not know how to access it or how to use it. Limited accessibility, it requires physical access. Now, cold wallets also have different types. You know, we said hot wallet and cold wallet. Now, cold wallets have different types. So we have like 4 major types of cold wallet. Hardware wallet like Ledger and Trezor. We have paper wallet, we have metal wallet, and we have offline software wallet. So let's talk briefly about all these kind of wallet before we go deeply into how can you trade your cryptocurrency and do some other important talks. So now, we now also have another type of wallet, which is custodial wallet and non-custodial wallet. So now, in addition to hot and cold wallet, it is essential to understand the difference between custodial and non-custodial wallets. Custodial wallets are cryptocurrency storage solutions where a third-party service holds and manages user private keys, controlling access to funds, e.g. blockchain wallets, Bitcoin, Coinjar, Sapo. So now, custodial wallet simply means you use the wallet online, and a company is the owner of that particular wallet. They will be the custodian of your private keys. Your private keys is the most powerful thing in the cryptocurrency wallet. Your private key is what gives you the access to be able to automate or authorize a transaction. So, in custodial wallets, your private key is with the company. So, if you have a blockchain wallet, for example, and use a blockchain wallet on your phone, your private keys are with the company. What they will tell you is just that, okay, create a username and password and create a PIN to be able to authorize transaction. But your private key is actually with them. But for non-custodial wallets, they are aware that they are storage solution where users hold and manage their own private keys, giving them full control of their phones. These wallets are usually safer. So I usually advise people to use non-custodial wallets because they are not easily hacked. And they give you a phrase, which is like your private key, that you have to write somewhere. Custodial and non-custodial wallets are usually used online. So it's not about being online or offline, it's about the private keys. So for custodial wallets, your private key is with the company. For non-custodial wallet, your private key is with you. So examples of non-custodial wallet are Trust Wallet and MetaMask Wallet. So you can just scan through this particular document, this particular picture. You can just pause the video, scan through the video and this particular document and look at it so that you can understand what custodial and non-custodial wallet simply means. Now, let's talk about cryptocurrency exchanges. What are cryptocurrency exchanges? Cryptocurrency exchanges are online platforms that enable users to buy, sell, or trade cryptocurrencies, offering various features such as trading pairs, other types, security measures, customer support, and all those things. There are different types of exchanges, including centralized exchanges, which are called CEX, and decentralized exchanges, which are called DEX. CEX, C-E-X, as you have it here, and DEX, D-E-X. So, I also have hybrid exchanges, peer-to-peer exchanges, and other exchanges like that. Now, exchanges is different from wallets. Wallets are for storing your crypto. Exchanges are for trading, investing, and some other things. So, if you want to buy crypto, you buy on exchange. If you want to trade, if you want to buy, sell, take spot trading, futures trading, you do all these things on exchanges. So we have two types of exchanges: centralized exchanges and decentralized exchanges. Centralized exchanges are CEX, are online platforms that facilitate buying, selling data of cryptocurrencies managed by a central authority or company. Like Binance, for example, they are managed by a company, which is Binance company. KuCoin, Coinbase, Kraken, Bybit, all these are centralized exchanges because they are exchanges that are managed by a central authority or a company. So their characteristics that centralized control, single entity managed operation is a company that's managing the operation. Custodial, which means all your funds are with them, just like we have in custodial wallet. User account, so they require you to open an account with them. You do KYC, you do all these things. Verification, know your customer, which is KYC, and AML, anti-money laundering checks. You have to put your details, your personal details, to be able to do KYC, to be able to use this kind of exchanges. And also security measures. They have encryption, they have 2FA, they have different code to be able to secure your wallet, and they have a cold storage. So examples include Binance, Coinbase, KuCoin, Kraken, and all those exchanges. Now we have decentralized exchanges. Decentralized exchanges are cryptocurrency exchanges or trading platforms that operate without a central authority or intermediary. That's the difference between SEX and DEX. Key characteristics: decentralized, no single entity control the exchange. Autonomous, smart contracts execute trades. It is autonomous. Trustless, no need for intermediaries. You don't need to do all this KYC, put your password, put your international passport, put this, put where is your home address. All these things are not needed. Censorship resistance, no single point of control. Examples are Uniswap, SushiSwap, Huff, any wallet swap, any exchange swap. They are decentralized exchanges. Balancer, Kyber network, and all those exchanges. So now, let's talk about the best trading platforms. So now that we want to talk about trading, we want to trade. What platforms are the best for trading? Right? For me personally, I've been trading for the past over 5 years. I've been trading for over 5 years now, and I've used a lot of platforms right from the beginning. And for me, at this point, at the time of making this video, these are the best platforms that I use for trading. The first one is Bybit, and Bybit is known for its high trust score and robust security features. Right? It's secured. KuCoin offers a wide range of trading options and high liquidity. KuCoin has a lot of gem cryptos listed on them, and Binance is one of the largest and most well-known exchanges with a wide selection of cryptocurrencies. So these are the 3 exchanges that I use to trade the cryptocurrency market. So now, if you want to learn how to use these exchanges, I don't want to make this video too long. That's why I did not include how to use them one after the other, because it's going to make the video extra long. So now, what we will do is that I actually have videos where I explain how to use KuCoin, how to use Binance, how to use Bybit, how to trade spot on Binance, how to do future trading on Binance, how to buy crypto on Binance, how to sell, and every other information that you need to be able to use this platform. So I'm going to link all those videos in the description box below so that you can watch them. Right? So once you watch all these videos, you'll be able to use each and every one of these platforms that I have mentioned here. So, but for me, at this moment, those are the best platforms for me to trade the cryptocurrency market. Right? So now, let's actually move forward and talk about some other important things that you need to know before you start trading cryptocurrency. So what is an order book? An order book is a list of buy and sell orders for a specific cryptocurrency organized by price level. It is a crucial component of cryptocurrency exchanges matching buyers and sellers. So now, we talk about buying and selling cryptocurrency, the base currency and put currency. So now, if you want to trade crypto, on an exchange like Binance, you have something called order book, which is like if you are buying Bitcoin, before your trade can be executed, the exchange will have to find someone that want to sell Bitcoin at the exact price you want to buy. So your orders will be matched together. So an order book is a place on your exchange that you trade that's going to show you active orders for buyers and for sellers. That is what an order book simply means. Now, what are the components of order book? We have bids, which are buyers. We have ask, which are sellers. Right? So you have bids, you have ask, which are sellers. Bid are the buyers, ask are sellers. We have price levels, which are orders as good by price, and we have order quantity. So this is typically telling you people that are active in the market. You don't know them, but you know they are buyers and sellers like you, active in the market and trying to make a trade. As we're talking about the components of the order book, you see that this is a perfect picture of an order book where you have the current price of that asset. This red bar is the sellers, people that are trying to sell BTC USDT, while this green bar are the people that are trying to buy. This is actually the place where you buy and stuff like that. So once you go to the videos where you learn how to use all these exchanges that I've mentioned earlier, you'll be able to get all these things easily. Now let's talk about, so the components of order books are all these things, bid, ask, price, level, and other things. So what is market order? A market order is an instruction to buy and sell a cryptocurrency immediately at the current market price. All these concepts are well explained in the videos of all those cryptocurrency exchanges like Binance, Bybit, and KuCoin. But I just have to give you a little bit of information about them. So what is a market order? A market order is an instruction to buy or sell a cryptocurrency immediately at the current market price. So if you want to buy Bitcoin, for example, and the current market price is $61,000, and you want to buy immediately, you use the market order. Then you buy immediately. So what is a limit order? A limit order is an instruction to buy or sell a cryptocurrency at a specified price or better. So now, let's say for example you want to buy Bitcoin, and you believe that Bitcoin is going to still go down in price, and you don't want to buy immediately. So you can set an order on the market or your exchange, telling them that okay, when Bitcoin comes down to 49k, activate an order for me. That is a limit order. So limit order is specific price. You have to put your own specific price that you want in the market, and no immediate execution and its priority execution. Right? So that is what limit order means. So we have two types of limit order. Buy limits, which means buy cryptocurrency at or below specified price. Sell limit, which is sell cryptocurrency at or above specified price. So those are type of orders we have in the crypto market. So now, then we have a stop order. A stop order is also known as a stop loss order. Stop loss simply means when you are trading and it gets to a point where you are losing your money and you don't want to incur a lot of loss, you can actually set a particular price in the market that okay, once the trade is going against me, immediately get to this particular price point, take me out of the market with a particular amount of loss. I don't want to lose a lot of money. So stop loss is actually important in cryptocurrency trading because it helps you with your risk management. It helps you identify how much risk are you willing to take on a particular trade and how much potentially you may lose if eventually the trade goes against you. So we also have two types of stop orders. We have the sell stop and the stop loss and the stop limit. Right? So those are the type of orders we have in the cryptocurrency market. So what are the purpose of these orders? Risk management. So you are trying to know when is the best time to get in the trade and when is the best time to get out of the trade in case there is a loss or even a profit. And also profit taking. So it helps you secure your gains if you make a profit from the crypto market. So now that is that about that. So let's talk about the bull and the bear market. The bull and bear market are important concepts you have to understand in the cryptocurrency market. Hard things like bull and bear market in the cryptocurrency market. So let's talk about what bull and bear market are. A bull market is a financial market condition characterized by sustained price increases, high investor confidence, strong demand, and economic growth. In a bull market, asset prices rise, market sentiment is optimistic, and investors buy and hold assets expecting further gains. Bull markets can be driven by factors like economic growth, monetary policies changes, technological advancement, and regulatory clarity. So now, in bull market, in 2021, we saw that Bitcoin climbed from around $10,000, $15,000, $20,000 to $68,000. Same thing happened in 2017. Bitcoin reached over $10,000 for the first time and stuff like that. So it happens every maybe 3-4 years in the cryptocurrency market, and this time it can happen by a time when the economy is growing and there's a lot of money pumped into the market. So in bull market, you want to buy and hold some coins into the bull market that allows you to make money from the market as an investor, even as a trader. And we have a bear market also. After every bull market, a bear market will come. A bear market is a financial condition when characterized by sustained price decline, when price will be going down. Look at the year 2022. Bitcoin crashed in price from over $60,000 to $17,000 in price in the 2022, which was during when the bear market reached its peak. So it's low investor confidence, weak demand. There will be very less demand for cryptocurrencies and economic slowdown or recession. Bear market can be caused by factors such as economic downturn, interest rate increases, global events, market over valuation, and regulatory changes. During the bear market, investors often adopt strategies like short selling, hedging, diversification, and dollar cost averaging to mitigate losses. Bear market also present opportunity for buying undervalued assets at discounted prices, but come with risk of significant losses and increased volatility. So, bear market is more like when the market is going in a downturn, when investors are losing money, and when a lot of financial crisis is happening all across the world. That is simply what bull and bear market is all about. So now, another concept we have to talk about is spot and futures trading. In trading, there are basically two types of trading. It's either you are trading spot or you are trading futures. Spot trading is a type of trading where financial instruments such as cryptocurrencies are bought and sold for immediate market delivery at the current market price. So for example, in spot trading, if you buy BTC, you have that your BTC available in your wallet, in your spot wallet. But in futures trading, it's not like that. Futures trading is more like a contract where you sign a contract, you have a contract that if a particular asset goes up or goes down in price with some rules that you make money or lose money. So I'll explain a little bit about it in a bit. So in spot trading, trades are executed and settled instantly, with asset transferred to the buyer's account immediately, just like I said. So in spot trading, it's more like you are buying something on the spot, right? So this type of trading offers high liquidity, flexibility, and transparency, making it suitable for day trading, swing trading, and scalp trading strategies. So let's talk about futures trading. Futures trading it involves buying or selling of a contract for an underlying asset. Buying or selling of a contract. That is futures. You are buying or selling a contract. You are not buying an asset and you are not selling an asset. If you are doing futures for Bitcoin, you are not buying Bitcoin, you are not selling Bitcoin, right? You are buying a contract of Bitcoin or you are selling a contract of Bitcoin. But in spot trading, you are buying the Bitcoin, the actual Bitcoin. So that's the difference between spot and futures trading. So futures trading involves buying or selling a contract for an underlying asset, such as cryptocurrencies, at a predetermined price on a specific date in the future. Futures contracts are standardized, exchange traded and settled on the expiration date with mandatory execution. Futures trading allows for risk management, speculation, and leverage. So now, one of the things that characterize futures trading as separated from spot trading is leverage. In futures, you have a leverage, which means a borrowed money by your exchange. So now, let me give you a simple analogy of what spot and futures trading is. If this iPhone, for example, you go to a market and you say you want to buy this iPhone, you go to a spot market, so you want to buy this iPhone. Okay, how much is this iPhone? iPhone is $500, for example. Okay, you give the seller $500. You as the buyer give the seller $500, and what do? They give you the iPhone. That is spot trading. But now let's talk about futures trading. Futures trading means you go to the futures market and you see the iPhone. You say, okay, how much is this iPhone? This iPhone is $500. I don't want to buy the iPhone, but I want to buy a contract for the iPhone, which means I'm going to give you $100 as my margin, right? Then I want to predict that this iPhone is going to go up in price to $550, which means I'm predicting that I'm taking a long trade in futures. I'm predicting that the price is going to go up. So now, this is $100. Borrow me money, more money, to complete the price of this particular iPhone. You know what? With that, I'm not actually buying the iPhone yet. I'm securing a contract. So now, once you borrow me the money, I'm going to put down my $100. I predict that the price is going to go up from 500 to 600. So borrow me additional 500 to my $100 to make 600. So once the price reaches 600, the price is not going to 600. So once the price goes to 600, buy the phone for me. You understand? You are not actually buying the phone, but you are securing the contract for buying of the iPhone. So once the price gets to 600, your broker or your exchange borrows you the money, they secure the contract, they buy the phone, the executive contract, once it reaches that particular price. And you'll be able to make money because they are selling the phone now for 600 instead of 500. You agree the price at 500, but you predict that it's going to go to 600. Then Then they borrow you money to be able to execute that particular contract. And once the contract is executed and the price has gone up from 500 to 600, you'll be able to make the money. They take back their own money, which is the leverage, and you have a reasonable percentage of profit. That is simply what futures trading is. So, because of leverage, which is borrowed money, you are exposed to something called liquidation. If the price does not go as planned, as you have already predicted, they take back their own money and they settle the market with your own money, which is your margin. And that's why they say you have a liquidation call. That is simply what spot and futures trading simply means. If you understand that analogy, let me know in the comment section. And also, if you have gotten value from this video, ensure you hit the like button so that this video gets to a lot of people, and subscribe to the channel. Now let's talk about fundamental analysis. How do you do a proper fundamental analysis of a crypto asset? How do you analyze an asset? Fundamental analysis is a method of evaluating assets, including cryptocurrencies, based on external and internal factors to predict future price movements. Unlike technical analysis, which focuses on price charts and trading patterns, fundamental analysis examines economic, financial, and other relevant data to access the real value of a currency. Fundamental analysis is more like you are trying to know whether an asset is undervalued or overvalued. You are trying to know whether an asset is what you put in your money in it or not. That is what fundamental analysis simply means. A lot of factors you have to consider to do a proper fundamental analysis of a crypto asset, and I'm going to talk about 3 major factors that you have to consider before you can do a proper fundamental analysis of an asset. To carry out the proper fundamental analysis of a crypto asset, you look at 3 metrics. I call them metrics, namely the financial metrics, the on-chain metrics, and the project metrics. The financial metric is more like you are trying to look at the finance of, like, the finance record or financial record of a crypto asset. So you look at the crypto asset in terms of investing in a company. If you want to invest in a company, one of the things you have to look is to look at their record, financial record. How are they doing? What is the total amount of profit they are making? What is the total amount of their revenue? What do they have, debt and stuff like that? So this thing applies to crypto as well. So if you want to analyze, this thing applies to crypto as well. So if you want to analyze a crypto asset, you have to look at all the financial metrics related to a particular cryptocurrency. So now let's look at financial metric. Financial metric actually play a crucial role in cryptocurrency fundamental analysis because it provides valuable insight into the economic viability of the project and the growth potential. So when you know the information about how a particular asset is doing financially, it's going to tell you if it has a growth potential or not. So when it comes to fundamental analysis, when it comes to financial metrics of fundamental analysis, one of the things you have to look into is what we call the market capitalization. What is the market cap of this asset? What is the total amount of money available in this asset? Then what is the trading volume? What is the trading volume? How much is going on in the market within the past 24 hours, within the past 7 days, within the past 1 month, 3 months, and stuff like that. So that gives you an insight into the amount of people or the amount of volume going and out of the market. Then you talk about liquidity, you talk about circulating supply, and some other key metrics that you use to evaluate the financial aspect of a particular asset. So all these things are something you can simply do on CoinMarketCap. The information that you can simply access via CoinMarketCap and see for yourself. So you can simply, let's say you want to look at a particular asset. This is CoinMarketCap.com. You can simply go on CoinMarketCap and look for how a particular asset is actually doing. So let's say you want to do a fundamental analysis of WIF, which is dog WIF hack, which is one of the biggest meme coin in the cryptocurrency market. So one of the things you can do is look at the financial metrics of this particular asset, and you can see it here. This is the market cap of dog WIF hack. This is like $2 million market cap. Then you see the volume in the past 24 hours. You see the volume market cap percentage. You see circulating supply. You see total supply. You see that the total supply has actually matched the circulating supply of that particular asset. So you can simply look at every necessary information about this particular asset on CoinMarketCap. So this is more like what financial metrics means when it comes to fundamental analysis. We have different tools for financial metrics. One of them is CoinMarketCap that I just checked, CoinGecko, Glassnode, CryptoSlate, and many other websites where you can do a proper fundamental analysis or a proper financial metrics fundamental analysis of a crypto asset. So now let's talk about on-chain metrics. On-chain metrics are vital components of crypto fundamental analysis, and what they do is that they provide unparalleled insight into a blockchain's operational health. How is it operating? What is the security type of this particular asset? What is the adoption level of this asset? What are these things? Those are the things that you have to look at when it comes to on-chain metrics. On-chain metrics is looking deeply into the blockchain of that particular asset. So that is what on-chain metrics simply means. So some of the key aspects of on-chain metrics that you have to look into when you are analyzing a crypto asset is the network security. How secure is this asset? What are the things put in place by the owners of the project to make it secure? What is the hash rate? What is the mining concentration? Is it true proof of work or proof of stake? And how is this asset being distributed? And when we are talking about distribution, if the asset is highly distributed to some of the owners, let's say for example the asset is like 100 units of that asset and 75% of it is owned by some particular people, maybe they are the founding members, then you know that is risky because these people can dump the asset at any time and everything goes back to zero. So these are the things you actually have to look at when you are talking about on-chain metrics. So looking at on-chain metrics, you can also get some on-chain data on CoinMarketCap as well, and also on Glassnode. So now let's talk about project metrics. Project metrics are crucial aspects of crypto fundamental analysis, providing valuable insight into project development, community, and operational health. When it comes to project metrics, it's more like, okay, this particular project, how is it developing? Who are those behind it? What is their motive? What they want to achieve with this particular project? Who are the competitors of this particular project? If you look at layer 1 project like Solana and stuff like that, you see that they are competitors. Cardano and stuff like that, you see the competition. Okay, what is this particular project doing better than its competitors? Those are the things you have to look at when it comes to a project metrics of the fundamental analysis through using project metrics. So when you are doing project metrics, you look at development metrics, assets, the project progress, quality. What is the quality of the asset? The commitment of the owners. Key indicators include updates, code updates, GitHub activity, development team size. Who are the people that develop it and what is the team size? What is the code of quality and stuff like this? So you can actually look up this information also on the website I mentioned earlier, on like GitHub and stuff like that. So with fundamental analysis, you'll be able to identify assets that are worth your money. You'll be able to know that this asset is actually worth investing my money in it or not. So fundamental analysis is more like a type of analysis that gives you the insight on what to invest in the cryptocurrency market. So now let's go into technical analysis and talk about technical analysis. Technical analysis is a method of evaluating cryptocurrencies by analyzing statistical patterns and trends in their prices and volume. It focuses on identifying potential trading opportunities based on market data rather than examining companies' financial management. So fundamental analysis is different. Technical analysis is actually different from fundamental analysis because when fundamental look at the project, the financials of the project, the management of the project and every other thing, technicals look at data, the charts. How has it been moving? What is the trend? Is the market moving up now? Is it moving down? Is it moving in between? Is it ranging? Those are the things technical analysis actually look at. And when you talk about technical analysis, there are a lot of things you actually look into when you talk about technical analysis. One of them is the candlestick chart. the crypto market, or let me say the technical analysis, is based on candlestick. Candlestick is the bedrock of technical analysis. So you look at the candlestick chart, you look at the market structure, you look at support and resistance, you look at candlestick patterns, you look at chart patterns, and we'll talk about some examples. So this technical analysis aspect is going to be interesting. So make sure you watch every part of it, and also, like I said earlier on, ensure you hit the like button and subscribe to the channel. So now let's talk about technical analysis. What is technical analysis? Is how you analyze the market using price data, using the chart to look at what is likely going to happen next in the market. So that is what technical analysis simply means. So now we are talking about technical analysis. The first thing you learn in technical analysis is what we call the candlestick chart. Candlestick chart. Every aspect of the market, everything on the chart is based on candlestick. If you look at this particular chart, this chart of Bitcoin against the United States dollars, you see that this chart comprises or consists of candlestick. You see that we have candles. So candlestick is the bedrock of any technical analysis. So you have to be able to understand the concept of candlestick charts. So this is a candlestick. You see that we have two candles. This one is a green candle and this one is a red candle. Basically, a green candle is used to represent the movement of price from a lower place to a higher place, which is telling you that price has increased. A red candle is usually used to identify or to denote the fact that price moved from a higher place to a lower place, which is telling you that price has fallen in. That's the opening price. Then we have the closing price, where price closed during that particular movement. Then we have the high, which is like the highest point price reached during that movement, and we have the low, which is the lowest point price reached during that movement. So it is the same thing for bullish and bearish candle. So if you look at a bearish candle, let's just look at a bearish candle. So let's look at this particular bearish candle. You will see that the movement started. When you say bearish candle, it means price went from up to down. So this is the open, right? Because price started from here, then it started moving down, and then this is the close. The open is the same thing as the high, and the close is the same thing as the low, because this candle does not have a shadow or wick. Right? It's very simple. For this candle, for this one, so let's just say this is the opening price, then this is the high, because before it started going down, it went up to this high. Then this is the low of the candle, and this is the closing price of the candle. So, and you will see that immediately candle closes at a particular point, the following candle opens at that particular point where the previous one closed. So that is simply the anatomy of a candlestick. So that is what a candlestick means. So your charts consist of candlestick. Every chart you want to analyze as a technical analyst consists of candlestick, but you can't analyze a chart without understanding what candlestick is in the first place. So now, body. Candlestick consists of body, which is the main part of the candle, showing the opening and the closing price. Wicks or shadows, I said it, thin lines extending from the body indicating high and low prices. Sometimes some candles don't have wicks or shadows. Color, typically green, which means price is going up, or red, which means price is moving down during that particular movement or time frame, indicating price movement. Then open, OPHLC, which is open, close, high and low price points during the movement. Now let's talk about market structure. There are basically three market structure in technical analysis. The first one is uptrend. The first one is what? Uptrend. So uptrend means an uptrend market structure is characterized by a series of higher highs and higher lows, indicating a sustained upward price movement. Second one is downtrend. A downtrend market structure is characterized by a series of lower highs and lower lows, indicating a sustained downward movement price. And sideways trend or range, which is a situation where the market is in a range of consolidation. A market structure characterized by a narrow price range with no clear uptrend or downtrend. So now, that is the three market structure we have. Is it that the market is going up, which is uptrend, going down, which is downtrend, or the market is choppy, which is a ranging market? Do you see this? You see that this is a low, higher high, higher low, higher high, higher low, higher high. So now, let's look at our chart and identify these things. Simple and straightforward. So, if you look at BTC, let's look at BTC on the other 4-hour or a daily. If you look at this market, you will see it's an uptrend. The market does not move in a single direction. You can never see the market moving like this. Let's say something like this. The market will never move up like this. Never. The market will never move up like this. It is not possible. The market moves up in a particular pattern, something like this, like this, like this, because anytime market goes up, there is always a reversal. We call these things reversals or pullbacks. So anytime market goes up, there is always a pullback. So these pullbacks are the ones that tell you that, okay, when market goes up, it rests, it relaxes a little bit so that the market can recover and give a room for a bigger movement. So that is simply what the market is all about. So now, I mentioned something as higher highs, higher lows, lower highs and lower lows and stuff like that. So anytime the market starts moving, you see this point, market started moving here, move up, reverses a little bit, moved up again, reversed, move up again, reverse, move up and reverse. So the point where it started is called the low. It started here, so we call it the low. This place we call it the low because it's a lower point, right? Then it moved up, we call it, this is the higher high. Higher high. HH, higher high. Higher high. Right? Then the market comes down, we call it the higher low. Why do you call it higher low? We call it higher low because this lower point is higher than the previous low, which means when the market moved up, instead of the market to go back to where it was coming from, it didn't. It still sustained a higher price, higher than where it was coming from, telling us that this market is still in a continued movement, which is like an uptrend. So that is simply what it means. So now I want to delete all this drawing and so now when the market started moving from this point, started from here, move a little bit, this is higher high, higher low, because this place is higher than the previous low. Then it went up again, give us a higher high, reverses higher low, higher high, higher low, higher high, higher low, higher high, higher low. And that is what an uptrend is. So now the logic is that anytime the market is moving in this kind of direction, it's telling you that the market is in an uptrend. Telling you when the market is an uptrend, you as a trader, you want to be looking for opportunities to buy. We'll be looking for long trades because nobody wants to be buying when the market is going up, right? Now we have something we call downtrend. We have a downtrend. So let's look at some other charts of some other crypto assets. Let's look at Mana. Most of the cryptos have been in an uptrend if you look at higher time frame, but if you look at this structure during this movement, you see that this particular point, market has been in a downtrend. This is lower low, this is high, then low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, before the market now started moving up. So this is what we call a downtrend. In a downtrend, you have a series of lower highs and lower lows. Just what we have here. It's telling you that the market is going down. But because the market is going down doesn't mean it's going to go straight down. It doesn't. the market is going to give opportunity for reversals so that you as a trader, you'll be able to have opportunity to jump into the market. You don't buy here, you wait for market to, let's say the market started moving here, come down to this lower low. You don't buy here because anytime the market goes in a direction, it tries to do a little bit of correction before continuing. Right? That is what a downtrend simply means. Now we have a sideways trend or a ranging market. You will see that during this particular time, look at this movement. The price is not going in a clear direction until it got to this place. It was at this point that it started going up. But during this movement that I circled, that I put this particular shape rectangle here, it is in a range, which meaning it is not going up in an uptrend direction and it's not going down. So now the logic is that if the market is an uptrend, you are looking for opportunities to buy as a trader. If it's in a downtrend, you are looking for opportunities to sell. And if it is in a range, as a beginner trader, you don't want to trade a range. But as an advanced trader and expert, you can trade the range. And what you do is that you buy the lows of the range and sell the high of the range. So you buy when the market is here and you sell when the market is here, which is simple, which we will also explain a little bit more later. So now, after talking about the market structure, which is the uptrend, downtrend, and range, now let's talk about candlestick patterns. Candlestick patterns. Apart from the fact that candlesticks form earlier on we talked about the candlestick charts, which is the basis of technical analysis. Now let's talk about candlestick patterns. When candlesticks are combined on your chart, they form patterns. And all those patterns that are formed, they have a meaning. They have a meaning we give to them. And these meanings are one of the things that tell us about the movement of the market in technologies. They give us signs that whether the market is about to start going up or is about to start going down. Now, we have a lot of candlestick patterns in the cryptocurrency market. If you search for candlestick patterns, you will see that we have quite a lot. You can see we have quite a lot of candlestick patterns, and you don't need to memorize all these patterns. All you have to do is understand them. So I've selected a few of these patterns for you to study. So once you just study the few patterns, you can always use them during your trade. So now, the first one I'm talking about is the engulfing pattern. Engulfing pattern. So it is divided into two: the bullish engulfing and bearish engulfing. I said earlier that bullish means price is going up and bearish means price is going down. So engulfing pattern. So candlestick pattern are graphical representation of price movement in financial market used to identify potential trading opportunities. Right? So in a bullish and bearish engulfing pattern are reversal patterns. It means when price is at a point and you see these patterns, they tell you the market is about to move in an opposite direction. Right? So now, when you have bullish engulfing, it means this market is red. You have a red candle, then you have a green candle after it. And the green candle completely engulfs the red candle. That's a bullish engulfing. Which means the people that are pushing the price down, they are tired. And the people that want to push it up, which is green, they are now ready to push it up. The opposite of it is the bearish engulfing, which means price is going up and at some point it got tired. Then the bears come in and they now engulf the bulls and they are trying to push the price down. So let's look at a pretty good example. Look at this particular candle. Look at this particular candle. You see there are two candles. That is a bullish engulfing candle. You know why? We have a red candle. Then we have another green candle beside it that completely engulfs it. That completely overpower it, telling us that the people that want to, the greens are now in the market and they're ready to push the market up. And what happened after it? The market went up. You can see the market went up. Right? So that is what a bullish engulfing is. We can actually also spot bearish engulfing candles. we can spot bearish engulfing candles as well. So okay, this looks like a bearish engulfing, but it's not actually a bearish engulfing. This is actually a tweezer. This is another example of bullish engulfing. This is a red candle followed by a bullish green candle that completely engulfs it. So that is a bullish engulfing. And what happens when you see the bullish engulfing? The price started going up. Though you don't start trading just because you see a bullish engulfing candle. There are some other factors that you combine with this particular candlestick before you enter a trade. But what it's telling us is that when you see this candle, they're giving you a clue that the market is about to start doing something spectacular, right? So that is it. So that is what bullish engulfing candlestick is. So you will see that in this example, at this point, we have a bullish engulfing. And what happened? The market started going up. Same here, we had a bearish engulfing in this particular chart. And after the bearish engulfing, the price started crashing. That is what bullish engulfing is. Second candlestick we're talking about is the morning star and evening star candlestick pattern. This is the morning star. This is the evening star. You will see that they look like a bullish engulfing and bearish engulfing, but there is a little bit different. There is one difference. The difference is that between the two candles, there is a very small candle. You will see that they look like a bullish and bearish, but in between them, there will be a very small candle. This is a red candle, bearish, telling you the market is coming down, followed by a small candle which is an indecision candle. It's a 50-50 candle, telling us that the market is neither going down nor going up, but it is not going down. You know, before it was going down, now it's no more going down, telling us that there is high probability that the bull's coming. Then followed by a green candle, now telling us, oh, now the market is no more going down. If you look at evening star, you see that this market is going up, then followed by a red candle that is very small, telling us that the market is about to reverse. Then the following red candle that is big confirmed the reversal. So if you look at this example, you will see on this chart that this is a perfect example. Once we saw this morning star candlestick, you know the market is going bullish. And once we saw this evening star candlestick pattern, you know the market is going bearish. So we can simply look at our chart and spot morning star and evening stars. We're actually going to get some examples. But one of the okay, let's look at Bitcoin. If you look at Bitcoin chart on a higher time frame, maybe like a weekly time frame, you can get a morning star candlestick from 2023 January. From 2023 January, this is a monthly candle. Okay, fine. This is a monthly time frame. You will see that this Bitcoin market has been bearish since October of 2021. It was going down, right? See, the market has been going down from October. Red candles. Now at this point, we found a red candle, right? Followed by another candle, which is very small. Red candle, but it's very small. When the candle is small, it's telling you that the movement in that candle is not strong. You see the previous one that are big, it tells you that the movements are massive movements. Now, we have this red candle, small candle, followed by a green candle. This is a morning star. Just compare it to what we have here, you will see it is a morning star, right? So that morning star candle, after the morning star candle, what happened to the market? The market started going up. Since this particular time, since January of the year 2023, over a year now, like almost 2 years now, the Bitcoin market has been going up, right? So that is pretty much what this candlestick, the message that this candlestick tell us. So it is same thing as evening star. Evening star is more like the opposite. That one is bearish, right? So the next candle we'll be talking about is the hammer. You see that this candle looks like a hammer. It's a bullish reversal candlestick pattern that forms during a downtrend. It forms when the market is in a downtrend. So you see that this market is in a downtrend. You saw the hammer. The candle actually looked like you are holding a hammer. And once you see the hammer, what happened? The market reversed. If you look at the chart we just checked now for mana, you would see we actually have a lot of hammer. So let's just zoom in this chart. So you will see that you have a lot of hammer. So this one looks like a hammer, right? And this is more like this particular chart, this particular candlestick looks like a hammer. You see this particular candle looks like a hammer. When we saw it, what happened? The market went up. So anytime you see a hammer at the end of a downtrend, that means the market is likely about to revert. So that is what a hammer does. So I'm going to look at more examples during the end of the analysis part of this video. Also, we have a hanging man, a man that is hanging. This one is the opposite of hammer. You see that the hammer is bullish and bullish reversal. Market is going down. You see hammer, it goes up. This hanging man, market is going up. You see hanging man, and the market starts moving downtrend. So when we get to the when we get to the analysis part of technical analysis, we'll talk more about that. Then we have the last one, which is the tweezer top and tweezer bottom. The tweezer means you have two candles. You have two candles, one green, one red, or one red, one green, or one green, one red. What this one is telling us that both of them have wick that is almost the same size, telling you price is being reversed, price is being rejected. So the logic behind tweezers is that if you see this tweezer bottom example, you see the market is going down. Now these two candles created the same low. Both of them ended at the same time. It tells you that this particular market tried to go down the more, but it could not, so it closed here. Then this one opens, also tried to go down, but it could not. It now started going up, which is telling you that it is 2 times price reversal. Price is being reversed twice. So when something is trying to go down first time, it was reversed. It tried to go down again second time, it was reversed. It means it could not go down and the price is about to shoot up. That is what tweezer candlestick pattern does. So we'll actually get to the analysis part and talk a little bit more about all these things. So now let's talk about support and resistance. Let's talk about support and resistance. What is a support and what is a resistance? A support simply means support and resistance is one of the important concepts that you have to learn in technical analysis before you can actually trade or analyze the market. So a support level is a level where the price tends to find support. So when something finds support, it means when something is falling, when the price is falling and it gets support, it means at that point there is something supporting it from falling and it's trying to push it up. So it's a price level where price tends to find support as it falls due to an increase in demand for the asset, right? This means that the price is more likely to bounce off this level rather than break through it. Now, resistance is the opposite of support. The price that is a price level where price tends to find resistance and it rises due to an increase in selling interest. So now, if we look at this particular picture, you would see that this particular price, whenever it goes up, it rejects. Goes up again, reject. The place where it is rejecting, trying to come down, is the resistance. And the place where whenever price comes to it, trying to go up, is a support. So let's simply look at the chart of mana. Let's simply look at this particular chart. If you look at this particular price point, you will see that anytime the market comes to this area, support and resistance are areas on the chart. They are not a straight line. Anytime price comes to this area, it bounces and goes up. You will notice that that's an area of support. And anytime price comes to this area, what happens? It bounces. That's an area of resistance. So it is a simple concept. Let me just put it this. Let me put it this way. So let's say market goes up, come down, try to go up again. It was pushed down, goes up, down, go up, a little bit down, up. So you will see that anytime price market comes to this price point, this area, buyers come in and push and buy. And when they buy, the market goes up. When there are a lot of buyers or demand, market goes up. And you will see that anytime the market comes to this price point, what happens? It starts dropping in price. That is a resistance. Support is a place where there is a lot of demand in the market trying to push the price up, and resistance is a place where there is a lot of a supply in the market trying to push the price up. So at support, you as a trader want to be looking for opportunities to buy, and at resistance, you want to be looking at opportunity to sell. But sometimes support gets broken. Sometimes support gets broken and it becomes a resistance. You see that, let's say the market breaks down and it starts going down. That previous support has now become a resistance. Why? Because the area that is previously a support is now the area that is resisting the price. Right? Support can turn into resistance, and the resistance can also turn into a support. So support is simply an area on your chart where price is rejecting and is trying to go up, and resistance is an area on your chart where price is rejecting and trying to go down. So let's simply look at the BTC chart or Ethereum and identify support and resistance. So if you look at this market, you see anytime price comes to somewhere around here, it tries to go down. You see, one, price came here again. What happened? It went down. Price came here again, it went down. Price came here and broke it. You see, it broke the resistance at this point. Now, if you look at this particular point, you see that anytime price comes to this area, it tries to go up. You can't draw it as a straight line. It's always an area because it can never be a straight line. I hope you really understand that concept. So, support and resistance is a simple concept that tells you that these are the areas where you should be looking for buying opportunities. Though your candlestick is going to give you clue that you should buy, but you will only use your candlestick when it is an area of support or resistance. So I actually have a lot of videos on my channel about support and resistance that are more explicit, like over 20-30 minute video on support and resistance only. I'm going to link them in the description below so you can as well watch them to learn much more about support and resistance, how to draw them and how to use them on your chart. So you can actually have multiple areas of support and resistance on your chart. This place is an area of support and resistance. This place is also an area of support and resistance, but you only trade from the most recent area. So now, if you look at this chart, if you draw support and resistance, it's going to give you clarity when you're analyzing the market. You see, market moves from support to support and from resistance to resistance. Market came to this place, is a resistance, came down to this support, broke the resistance and come back into this range. So at this point, the market is still an uptrend, right? You want to be looking for buying opportunities, but you don't just buy, you buy at support, at area of support. So this place seems to be a local area of support that is being formed. So anytime price comes back to this area and does something like this, look for opportunity to buy so that the price can go up. But the fact that I say you look for opportunity to buy doesn't mean you buy immediately. That is where your candlestick come in. So now you look for, when you get here, you look for candlestick. You see that initially when price got here, it gave us a candlestick, which is more like, this look like a hammer. Is it not a hammer? Yeah, this is a hammer. So this is like a hammer can tell you that, okay, at this support, buyers are trying to come in. And what happened? The price moved from around 60k to this area of 62k. That's how to analyze the market. So after support and resistance, I'll talk a little bit about chart patterns. Then we'll go into the analysis section so that we can analyze the market and see, we'll get a good examples for us to trade. So quickly, let's talk about chart patterns. What are chart patterns? Chart patterns are graphical representation on the chart. Graphical representation of price movements on the chart using a series of trend lines or curve. So when your chart moves, sometimes they form some patterns, and these patterns have meaning they add to your trading analysis. So now we have a lot of chart patterns in the crypto market, and when you look at chart patterns you can see thousands of them, but I'm going to be sticking with some of the most important ones in this video. So we have something we call double top and double bottom. So you can call them double top and double bottom pattern, or M pattern and W pattern. So now, what is double top pattern? So let's say the market is going in an uptrend like this. Let's say the market is going in an uptrend, creating higher highs and higher lows. Then it got to this stage and it could not go again, came back. Then instead of it to create a new higher high, it created an equal high and started dropping. You would see that this particular place, it created two same highs. You see that at this particular point, it created two equal highs. It created two equal highs, and after creating the two equal highs, it stopped moving. So we call that double top. So now, after creating that two equal highs, so let's assume the price now starts falling, right? And it started dropping. That is what we call a double top. So a double top pattern is a pattern that's created by your chart when the price stalled at a particular point twice, and after it starts changing direction. So now in a double top pattern, we have the first top, the second top, and this place called the neckline. So let's just look at something double top chart pattern. So let's look at something from Google. You can actually see this particular thing. You see this is double top chart pattern. This is the first top, this is the second top, and this is the neckline. So this pattern is a reversal pattern telling you price is about to reverse. So price is an uptrend. It hits this place, reverse, try to go up again, but it got rejected at this particular place or a similar place where it reversed previously. Then it started coming down. So now this place is the neckline. This particular point is the neckline. So we call this place the neckline. Let me just label this place as the neckline. The neckline. So when trading double top and double bottom, you trade the neckline break. Once price breaks the neckline, it starts dropping, and that is where you enter in most cases for beginner traders. But for some of us that have been trading for a long time, we might even enter at this point and ride it to this neckline and even much lower. So that is what a double top pattern is. Double bottom as well is just an opposite of double top. So let's look at this. These are examples of double top patterns. These are examples of double top pattern that in a picture. This is what a double top pattern looks like in a chart. You see that the market was in an uptrend, reached this first top, reversed to the neckline, reached the second top and started reversing again. So once it gets back to this place, you draw a line here and call it the neckline. And from this neckline, you find an opportunity to short the market because it is changing direction. So double bottom as well is just an opposite or a flip side of the double top, which means the market in a double bottom, the market is in a downtrend. The market is coming down, and it got to a stage where it could not go again, reversed, came back to this and created a second bottom and started going up. That is what the double bottom is. So now, looking at double bottom, this place is what we call the neckline, because this is where the neck of the pattern is, and once the market break out of this neckline, you look for opportunities to take a long or a buy trade. So that is the first two chart patterns that we'll be talking about, the double top pattern and the double bottom pattern. If you look at the Bitcoin charts, you can actually identify a lot of double tops and double bottoms on the Bitcoin chart. Clear example of a double bottom right here. So the market has been in a long downtrend, creating series of lower highs and lower lows, lower highs and lower lows, lower highs and lower highs, lower low, lower highs. Then they created the lower low here, and after creating this lower low, created a lower high. Instead of it to create a new lower low, it could not. So it created a double bottom. So after a double bottom, what happened? The market started going up, and there is a change of character or a change of structure, right? And the market started going in an uptrend. So this is what a double bottom looks like. So you see that this particular place is the neckline. So how do you trade double top and double bottom? The way you trade double top and double bottom is that you wait for this whenever you see this particular thing happening on your chart, you wait for the neckline to break. So you've seen that it has created the first top, go back, go up, and created another second bottom. You now draw your neckline here. You wait for the neckline to break, and when the neckline breaks, you trade using candlesticks or other conference or for confirmation. You don't just enter immediately. The market is at the double at the neckline. You wait for some signal to tell you this market is now ready to move. And what is signal here? You see this candlestick, this hammer candlestick that we have talked about earlier on, is what gave us the signal that okay, now this is a hammer, and people that want to buy, which are the bullish market participants, are now getting into the market. So all you've got to do here is simple and straightforward. So all you've got to do is take a long position from this particular point. So once you take a long position from this particular point, you put your stop loss just a little bit below this neckline, and your take profit will be the next area of resistance, which is somewhere around this place, right? Somewhere around here will be your take profit, and that will be a 1 to 4.8 trade. So it's as simple as that. So let's look for more examples of double top and double bottom on the chart. Still on BTC USDT, this is something that looks like a double top and double bottom. You see that this particular market has been in an uptrend, created a top here, reversed, and created another top. I will count these two as maybe as one, created another top, and it started dropping. So this place is the neckline, right? And the market now dropped massively. You see that these particular patterns are patterns that are giving back to massive movements in the market. They are patterns that are giving back to massive movements in the market. You see this is the neckline, and you'll be taking a trade at the break of the neckline. So now the neckline has broken. So immediately the neckline broke, the market reversed a little bit, then gave us this particular candlestick, which is called the hanging man. You know, that's why it's important for you to learn every concept we have been talking about in this particular trade. So this is the hanging man candlestick chart. After this hanging man candlestick, signifying that the market is now going to reverse. If you take a short trade here, or you sell this particular asset here, then you are going to make a lot of money riding the market from 64,000 up to like around 50k. That is simply how it works. So that is double top and double bottom pattern. We actually have a lot of patterns. Other pattern you can trade. We have the triple top. Triple top is just like an advanced double top, where you have something like this. Instead of having double top, you have triple top. So this place will still serve as the neckline, and you are going to trade it exactly. You are going to trade this particular pattern exactly the way you trade double top and double bottom. Right, so it is simple and straightforward. So we actually have a lot of other patterns, and I have a specific video on patterns on my YouTube channel. You can also find a link to that in the description box below. So now, having learned all these concepts, now let's look down into 2 or 3 charts and see how we can combine all these things together and apply them to your trading. Out of Solana USD, which Solana is one of the top cryptocurrencies in the cryptocurrency market by market cap and by value. And if you want to trade Solana, for example, one of the first things you have to identify is that, are you a day trader, swing trader, or scalp trader? If you're a day trader, you want to be playing on the 4-hour time frame downward. So let's say you look at your trend on the 4-hour, then you take trade on the 15-minute time frame. But if you are maybe a swing trader, you want to be looking at higher time frame like daily time frame, weekly, and 4 hour. And if you are a scalper, you want to be looking at 15 and 5 minute time frame. So the way you use time frame is determined by what kind of trader are you. So assuming you are a day trader and you want to be trading within the day, trading and taking profit within the day, I talked about day trading earlier on. So if you don't get that, you can actually look at the timestamp and watch that. So you would see that at this point, this particular market was in a consolidation, was in a range, until we had a breakout at this point and the market started going in an uptrend. Now, when the market started going in an uptrend, there is a reversal at this particular resistance. This is an area of resistance on the chart. And resistance simply means, like I said earlier on, anytime that at a point, whenever market gets to that point, it actually reverses. Now the market started now trending down a little bit. And I said, whenever the market is trending down, you want to be looking for shorting opportunities. Now, looking at this downtrend, you will see that there is also an area of value right here. And this particular thing looks like a double top. The market try go up, reverse, try go up again, and it created the neckline around it. So now, what you want to do is that you look at this thing. Initially, this market is an uptrend, right? But now it is trending down. So your bias would be that the market is still in a downtrend until the market breaks out of this particular zone. So let's say the market breaks out of this zone and retest it, then you say the market is now in an uptrend and you want to be looking for buying opportunities. So at this particular point, all you need is patience to be able to determine what you do. But generally, you have a short bias, which means you want to be looking for opportunity to sell. Because what? The market is trending down in the short-term movement, one, and the market is approaching a resistance. This is a resistance. This green line is a resistance. So this market comes to this resistance and it holds the resistance. Then you look for opportunities to short. If the market comes to this resistance, this particular area, and it gives you maybe candlestick pattern that's telling you the market is about to go down, maybe bearish engulfing or a hanging man and stuff like that, or maybe evening star and candlestick that tell you the market is about to go bearish, then you look for opportunity to sell the market and short it back to the downside. But if it does not and it breaks out of it, breaking out of this area is telling you that resistance has been broken. And when resistance is broken, you want to be looking for opportunities to trade the buy. So that is simply how you look at the market. So you don't just look at the market and say, okay, this market is coming down, I want to sell immediately. No. You buy and sell, you look at areas of value before you take your decision. What is happening? What area of value do you have here? This resistance. What do you do at resistance? To sell. But before you sell, you need to confirm whether the resistance is going to hold or not, because sometimes resistance do not hold, sometimes they hold. So when the market gets to this particular point, then you need to watch and see what is going to happen there. If the resistance holds and you see signs that the market is still going to continue coming down, you look for opportunities to enter. And if it breaks, you look for opportunities to buy. So it is two scenarios now. The first scenario is that the market go to this area of resistance, bounced and starts reversing, and you look for opportunity to sell, targeting a lower high. That is the first scenario. The second scenario is that the market goes to this resistance, break it. When it breaks it, it's now come back and it turns the resistance to support and now starts going up. So these are two scenarios that can happen. But what determines the scenario that happens is whatever happens at this area of resistance. So it could hold as a resistance or it could break and the resistance will turn to a support. So that is how to look at the market. This is how to look at the market, and that is how to analyze the market. So let's look at one more example. So let's look at BNB. BNB is Binance Coin, and you see that some of the concepts that we have learned, I've talked about, is there, which is the double top. You can simply see the double top here, right? The market was in an uptrend, give a top here, reversed, give an equal top, and came back and started dropping. So, like I explained for double top, all you have to do is just to put your neckline here, and once price breaks the neckline, you look for opportunities to take a short trade or to sell. That is simply about that. But now, the market has passed that level, and it has been a downtrend. But then, the market created a support at this area. Is that not support? Yes, that is support, because anytime market comes to this place, it pushes up. Now, the market is in a temporary uptrend, and in a temporary uptrend, we have a resistance. This is quite similar to what we had on Solana. So, what are you expecting? You are expecting that in this, though the market generally is in downtrend, but this is a temporary uptrend. So, if you look at this, you will see that it's a temporary uptrend that is happening. So, one of the things you have to do is you can draw a trend line right here and say, okay, fine. If the market breaks below this trend line, you'll be looking for opportunity to short. So let's say the market breaks below this trend line. Do something like this, look for opportunity to short. But if it does not, and it approaches this resistance again, and it breaks resistance, you are going to take a long trade. So that is how to look at the market in perspective. So if you want to get this kind of thing, I have a lot of videos on my channel that are analysis video. You can scroll back to like maybe a few months ago and see what I have done and the kind of analysis I have done on my channel to see how I analyze the market and how you should analyze the market to get the accurate trading decisions for your trades. If you have watched this video to this particular point, congratulations. I know you must have gotten a lot of value from this video. So make sure you smash that like button right now and subscribe to my channel. Also, if you want to learn a more advanced aspect of crypto, how to trade, and also you want to learn smart money concept and you want a mentorship so that you will be under an expert who have been trading the cryptocurrency market for a very long time, consider looking at the 10 Cryptocurrency Mastermind, where I teach exclusively how to be an advanced trader and investor in the cryptocurrency market, and I give signals, put you under my mentorship, lifetime, and other things. You can click on the first link in the description box below or somewhere around this video to look at that particular mentorship course and see if it is something you can get.